Hello, I'm Mark Patton. Thanks a lot for taking the time to join me for this quarterly workshop. I hope that you find it informative. The workshop is designed for both our clients and prospective investors, both of who might want to learn more about super diversification and the performance in particular of super diversification. I'm going to focus on the fourth quarter of 2019 as well as the full year of 2019. So I hope you find it informative. If you've got any questions for me at any point in time, either during this workshop, if you're watching the replay or any other time, you can always go to our website, and on the menu, one of the items is Contact Us. So if you click on Contact Us, you can send an email here with any question that you've got. This will go to both me and our customer service team. So if it's an investment-related question, I'll certainly answer that. If it's something administratively oriented, our customer service team will help out. So anyway, feel free to reach out at any point in time with any questions. Our phone number is over here on the right-hand side as well. So with that, let's get started. What I'd like to do first is simply provide an overview quickly of our super diversified portfolios. So a super diversified portfolio is one that's meant to be a total portfolio solution, meaning that it's designed to manage your entire portfolio. What makes it different than most portfolios is that we include things other than just stocks, bonds, and cash. So in our super diversified portfolios, we include things like commodities and gold, real estate, and so forth, things that provide more diversification value in the portfolio. So we believe that creates what we call simply a better portfolio. Again, it's meant to be a total portfolio solution, not just one piece of a portfolio, but it's a solution that is designed to manage your entire portfolio. And what I really like about this, being somewhat of a math geek myself, is that it's really built around math that works. It's about having things in a portfolio that don't always go up and down together, statistically looking at low correlation, mixing these investments together to produce the best risk-adjusted long-term rate of return, producing the best possible long-term return for the appropriate amount of risk in your portfolio. It's important to understand that inside the portfolio, we utilize low-cost index funds. Keeping costs low will help maximize your long-term returns. So we do this through the use of low-cost index funds. And we also often will include an allocation to our flex hedging strategy. That's our proprietary strategy that provides, again, additional diversification in the portfolio. If you want more details about that, you can either click on this link right here or go under Y Patent and click on Flex Strategy and read more about that. The last thing is that I'll point out is that every super diversified portfolio is custom built or tailored for each one of our clients. So we've got some clients who have a low risk profile and some clients have a very high risk profile and many clients in between. We can custom build every super diversified portfolio for each one of our clients so it meets their particular risk profile. During this webinar, I'm going to focus more on a growth oriented portfolio because we find that more than half of our clients tend to have a growth orientation to them. So I'm going to focus on that. So recognize that I'm going to pick one portfolio. It's not going to represent any one particular client portfolio, and it's not going to certainly represent all of our clients, but it's going to be a good representation of a typical growth-oriented client of ours. So with that, let's dig in here. So I'm going to log into our website, and you'll see here the exact same information you would see if you're a client of ours logging in as well. And this is an actual client portfolio, but again, it's just one of a few hundred client portfolios that we have, or a couple hundred client portfolios that we have, but it's a representation of our typical growth-oriented, super diversified portfolio. So when you come to our website, and you log in, it'll take you to our super diversified portfolio statements section of our website where we do all the reporting for our clients. Just a navigational tip: if you happen to navigate away to one of these, you can always roll your mouse back over the portal link and click on Super D statements. It'll take you right back to this page. So this defaults us to the performance summary report. So you can see that this account's been open since May of 2011 and goes through the most recent day. Now, just as a note, this is the only report on the site that goes through the most recent trading day. Everything else goes month to month, which you'll see in just a moment. So this will bring a client up to date through the most recent trading day, and you can see the performance cumulatively over time. So you can see this account's up 116% during that window time, and that's compounded annually at about 9.5% compound annually during that window time. So let's put some perspective around this. First, let's take a look at the holdings that are in this portfolio so you can see what the portfolio looks like. So here is a list of the holdings. On the left-hand side, you'll see the asset classes. We've got U.S. stocks, large, mid, and small. We have international stocks, both developed countries and emerging countries. Developed countries would be Europe, European countries, Japan and Australia. Emerging countries, kind of everything else, China, Brazil, India, and so forth. In the U.S. Category, you'll see we have a total of 18% split equally into these three different groups. And you'll see in the international component, we've got a total of 16%, 8 in each one of those two different categories. And then below, this is what really makes a super diversified portfolio different than most portfolios. Commodities, gold, real estate, which are publicly traded real estate companies, Berkshire Hathaway, which is Warren Buffett stock, then our proprietary flex strategy here. So these allocations are what really makes a super diversified portfolio meaningfully different than most traditional portfolios that are out there, and that we've included these additional asset classes. And these asset classes make up a total of 51% of the portfolio, so just over half the portfolio is in these alternative asset classes. The last one would be midterm U.S. government bonds at 15%. And now we do keep a relatively low allocation to bonds, which helps us maximize returns, but we're also getting reduced risk through these alternative investments. Most people will use more bonds in a portfolio to get a lower risk profile. We're doing it through a combination of both bonds and these alternative investments. That allows us to keep less bonds in the portfolio, produce a higher long-term rate of return, but do so with a risk profile that is similar to having more bonds in the portfolio. So it really goes back to that math that works that I was talking about, having things that don't always go up and down together. That would be bonds and these other things. Now, we're going to take a look at the performance, but we're going to want to compare it to something to see how it's doing relative to other things out there. I get a lot of questions about how do we measure the performance of our portfolios, and some people simply want to use the S&P 500, and it's just not a good benchmark for a diversified portfolio. I realize that the S&P has done extremely well for the last 10 or 11 years. It's been fantastic, and I'm a huge fan of it, just so you know. But a portfolio made up of just the S&P 500 is really a very risky portfolio, and it's really not what our portfolios are designed to compete against. So what we've done for each one of our clients is we've created what we call a benchmark portfolio. And a benchmark portfolio is a diversified portfolio. You'll see this particular benchmark portfolio is 70% in stocks and 30% in bonds and cash. A very typical growth-oriented portfolio, 70% in stocks, 30 in bonds. You'll see that the majority of it's in U.S. stocks, 60% in U.S. stocks, which, by the way, has made it very difficult to keep up with during this roaring bull market that's been led by U.S. stocks. We'll take a look at that as well. So you'll see 60% across various asset classes in the U.S. stock category, 10% in international stocks, and then you'll see 25% in bonds and 5% in cash. So here's what we're using as what we call our benchmark portfolio. So anytime you see the word benchmark, it is this that is being represented by that benchmark portfolio. So let's now take a look at that. I'm just looking at kind of my bullet points of agenda to make sure I kind of stay on track. The first thing we'll do is let's look at the risk and return. This to me is really my favorite graph. It's really what tells the entire story in my opinion. It's about the balance between risk and return. So many people don't want to talk about risk when things are going well, but risk will become very important when things aren't going so well. But you'll see here, this blue dot represents what we call the family, which is that diversified, super diversified portfolio. And then we've got the benchmark down here in green. So you'll see we can scroll down to this table and it'll give us some data on these data points. We've got return on the left axis, so obviously higher is better. And we've got risk across the bottom, which is left is lower risk and right is higher risk. So left would be better. So you'll see here that our portfolio has produced a better return, but with a little bit more risk. So let's put that in perspective. So you'll see that the compounded rate of return now, you'll see that the return is calculated during this time period from the inception of the account through the most recent month end. You can start and end this any point that you want to, just so you know. So it's fully transparent. You can look at it for a given year, for a given quarter, whatever you might want to do. That you'll see down here for the full time period that the super diversified portfolio, the family, has compounded at 9.3% compounded annually versus that benchmark at about 6.4%. So the super diversified portfolio has outperformed that benchmark by almost 3 percentage points compounded annually over time. And I'll show you what that means cumulatively because it's a big number. But this is a big deal. So we're very, very pleased with the long-term success of super diversification. Now, performance ebbs and flows. There are times when it hasn't performed quite as well as that benchmark, and there's other times when it does. But over time, the odds have clearly been stacked in our favor, really just through math, that we're making math work for all of us in these portfolios. And you'll see the risk has been a little bit higher. The standard deviation of our portfolio, just the volatility, how much it fluctuates up and down, has been a 9% standard deviation versus about 8.5%. So yes, it's I don't know, 6 or 7% more volatility, but almost 50% more rate of return. So this is a risk return trade-off that we're pretty happy with. So anyway, that's kind of the long-term picture. If you look at that during 2019 as an example, it's been slightly disappointing. So we look at 2018 to 2019, you'll see that we've produced a lot less risk. Our volatility has been about 25% less than the benchmark portfolio, but our return has been about 15% less. From 21 down to 18.5. So we've got a little less return, but meaningfully less risk. Again, this is not ideal. I'd rather have this blue dot up here to the top left-hand side. Better returns and lower risk is what we're ultimately shooting for. And I think that with time, we'll continue to do that. So there's a little glimpse of 2019. Let's take a little closer glimpse at 2019 as well. We'll go down to what we call the comparables trends report. A little bit of a complicated name there, but nonetheless, I'm going to turn off a couple things. So again, this goes for the full time period, and we'll look at 2019 as well as the quarter. But I'm going to turn off. So we've got bonds here in the orange line, really not a benchmark for the portfolio, but I just put it on there for reference purposes. And then we also have the S&P 500, which is this green line. Again, it's on here for reference purposes, but again, it's not a good benchmark for the portfolio. So I'm going to turn both of those off just for the sake of keeping things a little simpler for right now. And you'll see that the blue line would be that super diversified portfolio, and the orange, yellow, gold line is that benchmark portfolio. So cumulatively, which is pretty cool, remember it was about a 9.3% compounded return versus about 6.4. When you look at this, I guess it's right down here, 9.3 and about 6.4. But if you look at it cumulatively, the super diversified portfolio is up almost 115% versus the benchmark portfolio up 70%. So you think about that, $100 has gone to $170 in the benchmark, but $215 in the super diversified portfolio. So, you get a extra 1, 2, or 3% compound annual rate of return over time. It really adds up to a substantial amount of money over time. So I do get fired up about that. So there's the long-term picture. Now again, it wasn't perfect in 2019, and that we did underperform that benchmark. It was a great return, but it just underperformed, which I hate. So if we redraw this, let's turn these two lines off again. You'll see that the benchmark portfolio, outperformed the super diversified portfolio. It predominantly happened here in the fourth quarter, toward the latter part of the year. Doesn't really matter when it happened, but it did. Here in 2019, it lagged behind a little bit, but still, an 18.5% return versus 21.1 or so. For the quarter, you'll see that that's really when we lagged behind the most. Again, it happened. The underperformance really happened a great deal toward the end of the year. Again, I'm going to turn off those two just for simplicity, and you'll see that during this window time, actually the benchmark was up 5.3, we're up 3.4, and that really spoke to the entire difference for the year of 2019. Happened predominantly in the fourth quarter. It just happened when trade tensions started to ease a little bit and things started to rally again. You got a pretty big spike in U.S. stocks and really stocks all around the world, and that really drove that benchmark portfolio. So let's take one more look at a couple other details and wrap this up. So we'll go to the asset classes report, and this shows us the performance of each individual investment or asset class in the portfolio. Now this defaults to the full time period that we've got data. So you'll see that from 11 to 19, what these returns look like. We can go down here to this graph, and you'll see these compounded rate of returns. U.S. stocks have just been on fire for the past decade. So you can see that here, large, mid, and small stocks during the past decade. International stocks during this last decade have really lagged behind. International developing, emerging commodities, that's the price of oil down. Gold has basically been flat. There's REITs or real estate up, but not nearly as much as U.S. stocks. Berkshire Hathaway's done well, hanging right in there with the S&P 500, basically doing very well. Our Flex has done very well as well, really outperforming everything there over the full time period. And bonds have been positive, but rather muted, as you expect from bonds over that full time period. Now, if we look at 2019, let's dial this into a starting point of December of 18. So we'll go from December of 18 to December of 19, and we'll scroll back down here and take a look at these numbers. Now, number one, what's so interesting about this graph is that everything was higher in 2019. We've had that before, but it's pretty unusual, just so you know, that everything in the portfolio is higher. So we have had just an incredible run in the markets. It's been great. It's been great for the portfolios and everything. It's not necessarily entirely normal, just so we're all clear on that. But you'll see U.S. stocks, again, outperforming everything. So large U.S. stocks in particular, the S&P 500 doing better than mid and small stocks, but both also doing well. International stocks actually had a pretty decent year in 2019, still lagging behind, but produced a pretty decent rate of return. As you'll see there, developed in emerging markets. Commodities did well. Gold did well. Had some people kind of concerned maybe about inflation and so forth, but really not really showing up in the economy. That's kind of the argument for gold, but nonetheless, great diversifier in the portfolio, but not always a great return. You can see real estate did fine. Berkshire Hathaway actually lagged behind, so Warren Buffett's stock lagged behind, but it ebbs and flows like everything else in a portfolio. Our Flex lagged behind, which is disappointing, but still did well, but did lag behind certainly U.S. stocks, as we can see here, and bonds did well, up 8% in 2019. 2019 alone. So again, a year when everything did produce positive returns, and not only positive returns, but very, very nice positive returns. If we look at the fourth quarter, you're going to see that it's very different. So we'll scroll back down here. Actually, international stocks took off. You see emerging markets in particular had a strong quarter there. But here's U.S. large, mid, and small. Small stocks did well. So you had U.S. stocks ripping forward. International developed did well, but just lagged behind a little bit. There's emerging markets again. Commodities, price of oil was okay there. Gold, fine, but underperforming. And then real estate, our flex strategy was down a little bit, 1.7%, and bonds were down a little bit, while Berkshire Hathaway hung in there kind of with stocks. So very different quarter. They come and go. We never know, which bar on this graph is going to produce the best return the next quarter. That's simply why we diversify. So anyway, it's been 2019 was a fantastic year for investors. Again, everything was higher. The fourth quarter was a pretty strong quarter actually overall, but with U.S. stocks and stock markets overall leading the way, kind of this kind of rush back into more risky investments during that fourth quarter as some tensions started to ease a little bit. So that's kind of what the fourth quarter looks like. Looking forward, I'm very, very optimistic about the expectations on a super diversified portfolio. There's going to be a time when U.S. stocks will not perform as well as they have, and I'm not wishing or hoping for that, but it just will happen. It just happens over time. Things go through cycles, and when that does happen, we're going to be positioned very, very well. And even as U.S. stocks have done very well, certainly over the last 8 or 9 years that we've seen in this portfolio, we've still outperformed that benchmark that's been very heavily weighted in U.S. stocks, and we've still done better than it, even when that U.S. stock component that is so large in the benchmark portfolio and relatively small in the super diversified portfolio, we've still done better than that. So we're very, very pleased with the long-term results, and we believe that it'll continue to produce, comparable or even better returns going forward. A couple last things. If you're interested in doing a little reading and some research that we've done, you can go to Y Patent, and I've done rather extensive research on the cycles of the market, and I put it under the heading of avoiding a lost decade. And just quickly, I call it that because there was a decade prior to the most recent decade. So the most recent decade, kind of 2010 to 20 or so, and the decade before that was from late 99 to 2009. There was this 10-year window of time where the S&P 500 actually produced a negative rate of return over that 10-year window of time. People are forgetting that, so it's worth remembering that. I'm not, again, hoping or wishing or predicting this. I'm just saying that it's happened. And what I've done is I've looked at the performance of large U.S. stocks, and I've compared them to all these other things that make up a super diversified portfolio. So I've had one bucket that's just large U.S. stocks, this other bucket that has literally everything else, and it's amazing how these cycles occur where large U.S. stocks will lead the charge for a good long while, and everything else kind of lags behind. Then we go through these other cycles where everything else does well, and large U.S. stocks lag behind. And you'll see that down here in this graph, there's these cycles that have occurred over the past almost 50 years. So you'll see these trends and cycles have come and gone. So if you're interested in this, certainly take some time to read through this if you want to. I'm happy to talk to you about it as well. There's some live data actually that if you click on this, it'll show you this graph and kind of explain this graph a little bit more. But then there's also some live data that will show up down here down below when you select different things that will bring all this stuff even up to date through the most recent months. So anyway, I hope this has been helpful to you. One moment. And the one last thing that I'll mention to you is that on our website as well, I do a weekly blog. If you're interested in just kind of an update on the market, you can go to our media center here and click on blog, and it will take you to the weekly market commentary blog, as well as some educational blogs that I do as well. So with that, I'll wrap things up. Thank you very much for the opportunity to be of service to all of my clients that are out there. For those of you who are watching who are not clients, if you're interested in talking or if I can be of any help to you in any way, shape, or form, please let me know. So welcome the opportunity to do so. If you have any questions at any point in time, anybody out there, you can always go to the contact page here, and our phone number is there as well. Happy to answer any questions or help you out in any way. So I wish you all a great 2020. Thanks so much for the opportunity to be of service. We'll talk to you later.